Ladies and gentlemen, welcome back to the channel. Today, we dissect the United Kingdom's latest consumer confidence data, a tiny flicker of hope in what feels like an otherwise dark tunnel of economic stagnation. Yes, November gave us a surprise rise in consumer sentiment, with the GfK index climbing 3 points to -18, defying Bloomberg economists' projections of a decline. But before we breathe a sigh of relief, let's dig deeper. What lies beneath this superficial optimism? To all our loyal viewers passionate about financial development and those finance professionals trying to make sense of a turbulent economy, buckle up. We're about to break this down from point to surface and expose the hard truths hidden behind the numbers. To begin with, this increase in consumer confidence, a few percentage points, might seem like a win for new Labour Prime Minister Keir Starmer and his government. After all, stabilizing the political atmosphere after the notorious budget uncertainty tends to have one desirable effect: calming public nerves. However, let's not fool ourselves. -18 is no badge of honor, it's still deep in negative territory, far below pre-budget levels, and miles behind what we would call a stable economy. The optimism that so many headlines trumpet likely stems more from a psychological shift than any real economic movement. Let's be honest, confidence ticked up partly because people anticipated even worse outcomes after Starmer's government hinted at painful fiscal decisions. Reality wasn't quite as catastrophic as feared. So, in simpler terms, people were just less pessimistic, not necessarily optimistic. Now, to the root of the issue, the October 30th budget. First, Labour came in with bold claims: repair the public sector, spark capital investment, rebuild the country, and, oh yes, plug that infamous hole in the public finances. How? By slapping businesses with a £40 billion tax package, heavy on employer payroll levies. Here's the kicker: while this might look like a move to bolster public services in the long term, the direct consequences are concerning. For businesses, higher taxes often create a simple response: cut jobs, freeze wages, and pass on costs to consumers. That's precisely what economists fear will unfold as firms scramble to protect their profitability in a fragile economy. Let's not overlook the psychological factor here. The looming specter of higher unemployment and stagnant wages feeds directly into the lackluster consumer sentiment. Sure, there's a bit of a spending bump as people exploit Black Friday sales, but this is far from becoming a long-term trend. One key villain in this economic saga remains inflation. Despite the government's promises and some progress, inflation has not entirely loosened its grip on the UK economy. Persistently steep costs, from groceries to utilities, continue to eat into household budgets and erode real incomes. The Bank of England's "let's hold tight" approach to interest rates, signaling no urgent cuts, adds further complications. Long story short, don't let a seasonal uptick in sentiment fool you into thinking the cost of living nightmare is over. People may momentarily feel like they can treat themselves to a holiday deal, but everyday financial pressures remain relentless. Now, let's deal with the elephant in the room. While consumer confidence supposedly rose, official retail figures tell a different story. October's retail sales dipped by 0.3%. This disconnect exposes a telling truth: even if short-term optimism increases, it doesn't translate directly into sustained spending power in today's UK economy. With wage growth still trailing behind inflation, disposable incomes are effectively shrinking. Many households, especially lower-income ones, are turning to savings or credit cards just to make ends meet, further digging themselves into financial holes. Is this really a confidence win, or just delaying economic fallout? The UK's new Labour government has inherited a mess that would send chills down the spine of any economist or policymaker. Fixing public services demands enormous spending, but doing so in an era of high inflation and slowing growth requires something close to economic alchemy. Labour's tax-heavy moves targeted businesses instead of consumers, likely to avoid a public backlash after a crippling cost of living crisis. Politically, this makes sense. Economically, however, the costs might outweigh the benefits. Companies burdened by taxes are likely to delay or cancel new investments, stalling growth at a time when the economy desperately needs it. It's also crucial to zoom out and examine global factors influencing the UK economy. GfK's own director mentioned how the US presidential election had created ripples of uncertainty. The instability in the United States, coupled with persistent global inflation and high borrowing costs, dampened business and consumer decision-making worldwide. Brexit's lingering effects don't help either. The UK is still grappling with weakened trade relations, sluggish exports, and the uphill battle of redefining its economic identity post-EU. With exports struggling, the domestic economy faces even more pressure to perform, making consumer spending and business investment all the more critical. Here's the bottom line, folks. The modest rise in consumer confidence is akin to arranging deck chairs on the Titanic, not entirely meaningless but ultimately insufficient to prevent disaster. Let's summarize why. 1. Economic divergence. Households remain stressed under the strain of high costs, stagnant wages, and inflation. Businesses, facing higher taxes, will likely pass on costs or cut spending, directly contradicting the government's intent. 2. Budget fallout. The £40 billion tax plan, though theoretically aimed at repairing public finances, risks stifling economic activity in the short term and may harm growth potential down the line. 3. Monetary policies on hold. As inflation lingers and interest rates stay elevated, borrowing costs remain a significant obstacle to household and business relief. Economics isn't just about numbers, it's about balance. Governments must walk a tightrope between raising revenue, controlling inflation, and fostering growth. Unfortunately, Labour's budgetary approach might tilt the scales toward austerity-like outcomes, discouraging businesses from job creation and investment. To truly restore confidence, the UK needs more than temporary sentiment bumps or publicity-grabbing tax announcements. It needs policies that encourage broad-based income growth, technology-led productivity boosts, and consistent public investment in critical infrastructure. If not, well, 2024 risks becoming another year of financial disappointment for businesses and consumers alike. Ladies and gentlemen, don't let flashy headlines and superficial numbers fool you. Yes, consumer confidence rose in November, but economic recovery is a marathon, not a sprint. The UK's core economic glitches, persistent inflation, business hesitancy, and shaky public finances, require systemic, forward-thinking changes. Until then, we'll continue to ride this roller coaster of fleeting highs and persistent lows. Keep your wallets tight, your eyes open, and join me next time as we peel back more layers of the global economic onion. And remember, I don't just explain economics, I make it crystal clear. Thank you for watching. Leave your thoughts below. Do you think the UK's economy is on the mend, or are we heading toward more turbulence? Don't forget to like, comment, and subscribe for more no-nonsense financial insights.